Hello, everybody, and thank you for joining us today. My name is Margaret Hiller, and I am joined by my colleague, Lisette Smith of the advisory group. We are putting on a two-part series. I will be speaking with you today about steps to take to financially launch your children. And Lisette will be speaking tomorrow with you about difficult conversations with aging parents. We hope you can join us tomorrow for part 2 as well. We see a lot of clients, and we ourselves, who are in or have been in what we call the sandwich generation. So this is the stage where you have children at home who still need your guidance and your parenting, even if they're getting a little older and increasingly independent. But you also have aging parents who may be beginning to lose some of their independence and are needing additional help from you. This can be a challenging time for those who are in the middle. So today we want to focus on how to financially prepare and launch your children. I am a parent of 2 girls who are currently 17 and 14 years old. My older daughter is preparing to leave for college, and I'm sure that she's generally becoming more independent and ready for the next steps of independence. But as a parent, and particularly as a financial professional, I know that there's more work that we need to do to help her launch financially. I don't want to be the cobbler whose kids have no shoes, so to speak. So we wanted to share with you some of the areas that we think are important to focus on with teens before they leave home. First and foremost is general financial literacy for teens, which includes topics such as checking and savings, budgeting, loans and credit, insurance, investments, income taxes, retirement savings, and estate planning for young adults. Today, we would like to review those topics with you, in addition to things further down the road, such as ways that you might be able to help your child as they look to enter the real estate market, and for you parents, what to do if you have 529 funds that are not used up. The first financial literacy topic is checking and savings accounts. It is very important that every child over the age of 13 open both a checking and a savings account. And some start their savings accounts even younger. When they open their checking account, you want to be sure to give them a debit card and teach them how to use that card for expenses, but also how to deposit funds into the account using mobile deposit and also depositing checks through the ATM. You want to teach them that checking accounts are for daily use and savings accounts are for medium-term savings. For example, if they're saving up for a big expense later in the year or next year. You also want to teach them that checking accounts are really for daily inflows and outflows and have features such as online bill pay, whereas savings accounts do not. Savings accounts also have a limited number of withdrawals per month, so they can't be planning to take funds out of that account regularly. That is really something they're going to put money in and it will stay in there for some period of time. You definitely want to teach your child how to do a bank reconciliation and also how to write a good old-fashioned check. I think that's becoming a lost art, but they may still need to do that sometimes. So it'd be good for them to know how to write out a check if they need to. Another financial literacy topic for your teen is the subject of budgeting. So every teen who leaves home needs to learn how to create a budget, which is essentially a monthly plan of how their money is going to be spent. There are some terrific apps out there that can help. One that I'm familiar with and that we've recommended to some other teens is called Simplify by Quicken. You want to teach your child that when they set up their budget, they need to budget for taxes that are going to be withheld from their pay and the amount that they're going to set aside in savings, because we'll talk later, you're going to teach them the importance of savings, and also to budget some funds to set aside to plan for the unexpected. because the thing about unexpected expenses is you never know what they're going to be or when they're going to come, but you do know that there will be unexpected things that will happen along the way. So you want to teach your children to budget for their monthly expenses, but also plan for the amount of savings that they're going to set aside and how much they're going to set aside for unexpected or emergency situations. The subject of loans and credit is a particularly important one. When your child turns 18, this is the age that they are going to start establishing their own credit. You want to teach them about the credit reporting agencies, which are TransUnion, Experian, and Equifax. As you know, these agencies keep score on everyone and keep track of your spending habits and how much you use your credit and whether you pay your credit card balances off. And these scores are very important as one goes to rent an apartment or to buy a first car or someday buy a house. When your child leaves home and goes off to college, the credit card offers are going to start showing up. It is important that your child apply for a first credit card because you want them to start establishing credit, but it's very important that they use it responsibly. A student credit card typically has a very low limit. It might only be a couple of $100s, and it usually has little or no income requirement. As your student uses the card and pays it off each month, the limits will begin to increase over time. Teach your child to set up automatic payment deduction so that the card is paid off in full each month without risk of accidentally missing a payment. Because of course, it's that missed payment that's going to hit their credit score hard. You also want to show your child how to track their expenses so that they are sure that they know at all times how much they have spent and how much that final bill for the month is going to be that's going to be deducted out of their bank account. I also think it's generally a good idea, if it makes sense with your child, to give them a credit card that is tied to your account. Now, this card would not help them in terms of establishing credit, but then they have that card in the event of an emergency in case they incur or need to incur some kind of expense that's higher than the low limit that they have on their own student card. There are many different types of loans that your child may take over the years. They may have student loans, a car loan, a mortgage, to name a few. So you want to teach your children that there is good debt and there is bad debt. Bad debt has high interest rates, no collateral, is generally revolving credit versus an installment loan. So as a reminder, revolving credit does not have a scheduled payment plan to pay down to zero, and whereas an installment loan has an amortization schedule, basically. The best kind of debt has low interest and has an appreciating asset for its collateral, such as a mortgage that's used to secure a house. Lastly, you want to be sure to teach your child how to compare and to evaluate two loans to determine which is better. It's important to keep in mind that it's not the payment amount itself that determines whether the loan is a good or a bad deal, because as you know, payment amounts can be manipulated with longer term loans or interest only loans. The important consideration is how much they're going to pay over the life of the loan, including principal and interest, until it's paid off to zero. Another subject that's potentially confusing to young adults is the subject of insurance. What kind of insurance do you need and how does it work? There are two types of insurance that a young adult must be sure to have at all times and never go a day without. So first and foremost is medical insurance, and the second is car insurance if they drive. And the reason we consider those to be the two most important types of insurance is that those are the types of risks that are not high likelihood of these things happening, but very significant magnitude. So if you had a very significant medical situation or a car accident, either that harmed you or harmed somebody else or damaged your vehicle or another vehicle. So you want to be sure that your children understand that they always need to have medical insurance and car insurance. They also might consider renter's insurance, but again, the risk of loss in a rental is not as high as the potential magnitude of loss for medical or for car. they're not likely to need any other types of forms of insurance until they're older and have more financial responsibilities. So as you teach your children about the choices for medical insurance, you'll want to teach them about HMOs versus PPOs and the pros and cons of each. HMOs, as you likely know, have lower monthly out-of-pocket costs, but have less flexibility to see specialists or to use out-of-network providers. PPOs are a higher monthly cost, but have more flexibility. You'll also want to be sure to teach your children about premiums, deductibles, and copays. So while they may be able to stay on your insurance as long as they're a full-time student up until the age of 26, they will at some point need to become familiar with these terms before they go out onto their own and have their own insurance coverage someday. It's also very important to introduce your child to the concept of investing. I think part of the reason it's important is that you want to teach them the way that you think about investing and what's worked well for you, rather than let them find this out from somebody else whose values and opinions you may not share. You will want to give your child a simple, high-level introduction to investments. Our introduction is essentially this. All investments in this world boil down to three types, which is essentially stocks, bonds, and cash. So stocks are equity or ownership of a company. How do you make money when you invest in a stock? Either you collect dividends or you hold it and hope to sell it at a higher price later. Bonds are loans, and bonds may be loans to governments or to corporations or to municipalities. How do you make money with bonds? So mostly you make money through the interest that is paid to you on the loan before the entity repays you the full balance. A mutual fund is simply a basket of securities, which could be made up of individual stock or bond investments or both. And then a money market fund is simply a mutual fund that invests in cash investments. The stock market is a platform where people go to buy and sell stocks. It's important to teach your kids that all investments have risks. There are all different types of risks. You can have credit risk, you can have volatility risk, you can have risk of interest rate fluctuations, you can have inflation risk. The stocks and bonds are very volatile, meaning that their value fluctuates daily and sometimes values go down significantly, like we've seen happen recently. Bonds are very sensitive to changes in interest rates and also have credit risk, meaning that if you make a loan to an entity that is not financially sound, they may not be able to repay the loan. Cash and money markets are subject to inflation risk, meaning that they are going to lose purchasing power over time. And that's something else that we've also seen a lot of over the past year, is that our $1,000 that we might have doesn't buy as much as it did a year ago. When you teach your children about investing, it's important to discuss the concept of risk and return. One must be willing to take on some level of investment risk to have the potential for higher returns. However, you have to be careful not to take on too much risk that you suffer from catastrophic losses that you can't recover from. You can afford to have some fluctuation up to a certain level and know that you'll be able to recover. But for example, if you lose 90% of your value in a security and you're now down to $10 where you had 100 to begin with, you would have to have 10 times the return to get back to your original $100. We use diversification into different asset classes with different risk and reward characteristics as a way of being sure that you don't put all of your eggs into one basket. Diversification helps to reduce the volatility along the way. So when one invests in a diversified portfolio with stocks and bonds, there will be volatility along the way, and this is not news to you if you've been paying attention to the markets and to your accounts lately. But we have to be willing to experience these bumpy periods in the markets to give ourselves the potential for higher returns over time. It's also important to explain to your child how time factors in. If you invest in a predominantly equity portfolio, mostly stocks, you can expect that in any given year, you could have a very wide range of returns. It might be very high double-digit returns, it could be very low double-digit returns, or somewhere in between in any one given year. However, that same portfolio will have a narrower range of returns over 5 years, and even a further narrower range of returns over 10 years. And this is because the longer the time horizon, the volatility dampens out over time. If you have a long time horizon, you can therefore afford to take on the volatility of stocks and know that even if you have a situation like we have this year, you will have time and will likely be able to recover. If you have a short time horizon, you do not have time to take on as much volatility, because if there is a significant decline, you may not have time for the recovery. So these are the kinds of topics that we discuss with our clients, and we think that it's important for you to discuss with your children as they're learning about investing and the stock market.
Margaret, maybe before you move on, we do have a question kind of related to investments and also inheritances. Like, when do you suggest, or maybe what do we tell our clients, and I know it varies, in terms of when you should let your children know about trusts that they may have or inheritances that they may be getting, and maybe talk a little bit about those conversations and how we talk to our clients about that.
I think the answer to that question really has a lot to do with your child and the maturity of your child. And, if you have a child that you have confidence that even if they understood that they might have an inheritance coming in the future, that they would not change course in terms of what they're doing for themselves, that might lead you to tell them sooner. But if you have a child that you worry that if they knew that they don't really need to worry about money in the future, that they might be less inclined to save, then that might cause you to wait a little further before you share that with them. I do think it's important, though, and we'll talk about this further in tomorrow's session when we talk about conversations with your parents. There is going to come a time where your children are going to be helping to navigate the ship as it relates to your own assets. So there will come a time where I think everyone should start becoming more open with their children about their situation. My personal belief is to keep it very high level and keep it very general when your kids are teens and very young adults. But then as they get into their 30s and 40s, that might be a more appropriate time to start sharing with them what your plans are in terms of your estate, so that there are no surprises when they see your will and your trust, and start giving them a better idea of your assets and how you've chosen to manage those. You set the example for your children and presumably made good decisions over the years to get to where you are, and so it's good to engage your children in that conversation and have them learn from what you've done right. And I would tend not to do that when they're still teenagers, but other than these high-level topics we're talking about here. But when you start opening up and sharing more personal information, I think it's going to depend somewhat on the child.
Excellent, thank you. Yeah, and we will talk a little bit more about that as an adult child, seeing your parents' financial information tomorrow.
Excellent. So the next topic is the subject of estate planning. And this one tends to catch people by surprise. It does seem hard to believe, but it's true that when your child turns 18, they will need some basic amount of estate planning. Once your child turns 18, even though they may still be financially dependent on you, they are a legal adult. So before they leave home, there are a few documents that you want to be sure that they put into place. The first one is the Advanced Healthcare Directive. So this is where they specify their wishes for medical treatment in the event that they're unable to make their preferences known at that time, in some kind of emergency situation. There also is the HIPAA authorization. So this is a document that your child signs and provides to doctors and hospitals to release to allow those entities to be able to provide their private medical information to you as their parents or to anybody else that they designate. It's very important that you have that document already prepared in advance of an emergency. It just makes things easier for everybody. Then we have a durable power of attorney for healthcare, which we sometimes call a DPOA, durable power of attorney. This is the document that your child will sign to grant you as their parent the authority to make medical decisions on their behalf if they're not able to do so. So again, that's an emergency situation. Then we have a durable power of attorney for financial matters. And this will allow them to take action, allow them to authorize you to take action on their behalf in either a legal or a financial capacity. And you can sign these either to be effective at all times. If they want to grant you these authorities, it can always be there. Or they can set them up as springing powers of attorney, meaning that it only goes into effect if a certain situation happens, for example, incapacity. And then the last document that you will want to have your child sign is the FERPA release. This is the document that allows colleges to release their report cards to you. You know, back when I was in college, my college happily mailed my report card off to my parents, whether I wanted them to or not. I think they figured that if my parents were helping to pay for it, that they had a right to that information, but that is not the case now. So even if you are paying for your child's college tuition, you do not have access to their grades and their records unless your child has signed a FERPA release. As for where to obtain all of these documents, there are some reputable websites that might be helpful, or you might use your own estate planning documents as a template, or you might contact your estate planning attorney who can put something together that's very simple. And this is all just very initial estate planning, which, as you can see, is very focused on incapacity management. And then, of course, as your child gets older and has a more complex financial situation, then they will be in need of a more extensive estate plan, which will likely include a will and a trust. And then there's the subject of income taxes. So it always comes as a shock to teens when they get their first real job and they show up on day one and they're handed a very confusing tax form that they need to fill out. And then, of course, they get their first paycheck and they were earning, let's say, $20 an hour, and they worked 10 hours and they were expecting $200 to come into their account, and instead it's some lesser amount because there were some taxes withheld. So you want to teach your children about the cycle of the tax flow. So it starts on day one of employment when you fill out your W-4. And then they'll receive their W-2 in January that will show them all of their wages and their taxes for the year. If they have any investments, they'll receive a 1099, which is a tax report showing investment income and capital gains. And then they'll need to file their tax return by April 15th. When it comes time for your child to file their first tax return, you want to teach them how to complete and file the return for themselves. You don't want to do it for them or have your accountant do it, unless, of course, there's something unusually complicated about their return. If you have any investments that perhaps your child doesn't even know about that belong to your child, and that creates a more complicated tax return, then that might be justification for having either you or your accountant file the return. But if your child's only reportable income is their W-2 wage and perhaps a little dividend on a stock or a bond that they own, you do want to teach them how to get in the habit of filing taxes. It's something that every adult needs to do, and so they learn that at a good young age. So this raises the question, when is that first tax return required? If your child has only wage income, okay, so they've just worked at a job, they don't have any other investments or anything, it's very easy. They can earn, for the year 2022, they can earn up to $12,950 before they have to file a return. If your child has only unearned income, so that's that is investment income, so capital gains, interest, dividends, but they have no earned income, then it's also very easy. The first $1,150 is not taxed. The next $1,150 is taxed at the child's rate, and then amounts over $2,300 are taxed at the parent's rate. But where things get more complicated is if your child has both earned and unearned income. If they have both, and this could just be that they have a job, they just earned a few $100s, working briefly over the summer, let's say, and they have a few little investments that you've been setting aside for them or grandparents have given them or something, it's possible to run into this situation. So they have earned income and they have unearned income. If they have both, they must file a return if their unearned income is more than $350 and their total income is more than $1,150. Okay, so if unearned income is more than $350 and total income between the two is more than $1,150, then they will need to file their first tax return. We should also add, though, that your child may wish to file a tax return before it's truly required. For example, if they've had taxes withheld from their pay and they would like to claim a refund. The IRS has devoted an entire publication, which is number 929, to the subject of the tax rules for children and dependents if you need more information. And then there's the subject of retirement. If you try to talk to your kids about saving for retirement, they might give you a funny look. They're thinking to themselves, I'm worrying about graduating from high school, and the subject of retirement has really never entered my mind because that's still 45 years off. Okay, so you say, yes, that's exactly why you need to start thinking about saving for retirement, because you have so much time to build the account. So you'll want to just teach them the high-level basics about retirement. There are two different types of retirement accounts, generally. There are pre-tax savings, and that's your traditional IRA and 401k, and then there's Roth after-tax savings. So with pre-tax savings, the savings goes in without federal or state income tax, and then you pay ordinary income tax on the amount of the withdrawal. With these pre-tax accounts, you must keep your funds in the account until you reach age 59 and a half, or you will also be subject to a 10% penalty for early withdrawal. With Roth IRAs or Roth 401ks, you do pay tax on the contribution when it goes into the account. And if you follow all the rules properly and you have what's called a qualified distribution, you will pay no tax on the amount of the withdrawal, on any of the withdrawal. So with Roth accounts, the earnings are never taxed, and that's really the big selling point of Roth accounts. And if you've had that account for decades, as would be ideal, the majority of that balance may be made up of earnings. So the nice thing about Roth is you pay tax when you put the money in, and then you let it compound for decades. And when you go to withdraw, you don't pay any tax on the amount of the withdrawal. So in general, and we advise clients on this as well when they're thinking about their own retirement savings, it's a very important consideration what tax bracket you are in today versus what tax bracket you expect to be in when you retire, to help you decide whether it makes sense to save on a Roth or a pre-tax basis. For virtually every teen, it will be in their favor to save on a Roth basis because they are in a very low tax bracket. They might even be in a 0% tax bracket or close to it. One must have taxable income to save into these types of accounts. So you have to wait until they're, that they're going to get their first W-2, and then you can work with them to help set up an account. So as soon as your child has their first real job, and a taxable job, not just babysitting down the street, have them set up a Roth IRA and begin saving into it. And you might want to, help them, because let's say that they earn $1,000 during the year, but they don't want to put every dollar into a Roth. Maybe you agree to do a little on the side match to help them reach a minimum contribution amount and open up the account. You just have to be sure that the total of what you put in does not exceed what their taxable earnings were for the year. If your child is under 18, you can even set up what's called a custodial Roth IRA, which will automatically convert to a regular Roth IRA when they reach the age of majority. But again, you have to be sure that they have taxable income before you set these up. Keep in mind also that if your child will be applying for financial aid for college, these types of accounts will be considered assets for aid purposes. You want to teach your children that there are 3 things that you will need to be successful when you save for retirement. The first is that you need to save enough. You need to contribute enough. Generally, that is at least 10 to 12% of pay throughout your working career. The second is you need to earn a reasonable rate of return, which means that you need to invest, because if you put your money in cash, you will not be earning much more than inflation. And the third thing is that you need to give yourself enough time to save and enough time for the earnings to compound. That is usually, in my mind, a minimum of 30 years, and the longer the better. This is why if they're 45 years away from retirement, it only helps them to start early. Teach your kids these principles and help them to make it a habit as soon as they begin working. Just tell them that if they save at least 10 to 12% for their entire working career, no matter what their income, whether they're earning $10,000 that year or $1 million that year, always save 10% at least. And hopefully there'll be company match on top of that. And be sure to invest their money and understand the risks that we talked about, and give themselves at least 30 and hopefully many more years to do so. Then they will set themselves up well for retirement. Looking ahead, so as your child enters adulthood and eventually becomes financially independent, there will come a time that it makes sense for them to try to enter the real estate market. And for those of you from the Bay Area, you can attest, it is becoming increasingly difficult for first-time home buyers to get into the real estate market. So what we're seeing is that young adults are having to lean on their parents more and more for assistance if their parents are in a position to do that. There are various ways that you can help your child to get started in the real estate market. First, of course, you can gift them part of the down payment. So the annual gift limit this year is $16,000. And if there are 2 parents, each parent can gift that amount to the child. And if the child is married, and if you are so inclined, each parent could gift the $16,000 to the child and the spouse. So this would provide for up to $64,000 of assistance on the down payment by way of gifting. So people are often under the impression that the annual gift limit is the most that you can give. But this is not the case. The annual exclusion is the most you can give away without triggering a filing of a federal gift tax return, which is Form 709, and or reducing your lifetime exemption amount. But if you gift more than the annual exclusion, you will report this amount on Form 709, and then you will deduct it from your lifetime exemption. The lifetime exemption is currently very high. It's over $12 million currently, but this amount is scheduled to drop to $6.2 million by the end of 2025 if current laws do not change. There are other ways that you can help your children. So one is that you could consider loaning the funds to them and forgiving that loan over time, even in the amount of the annual gift limit. For example, you could loan them $100,000 or $200,000 and then forgive up to the annual gift limit each year. And you have to factor in interest as well, because if you make a loan to them, they are supposed to be repaying you interest, or that interest itself is considered part of the gift. You could also help your child buy a property that has an additional dwelling unit, which is referred to as an ADU. So, for example, maybe they're looking for a home in a certain price range, but you help them to get into a higher price range and get into a house that has an ADU. That ADU could be rented out for additional monthly income, and eventually, perhaps you could move into the ADU when you no longer want to live on your own. And we're seeing more of this. We're seeing more of people in this kind of sandwich generation age that are interested in having ADUs and having their parents move in rather than moving to a nursing home, for example. There are also strategies you can use if you have the resources to do so to help your child to put forth a more attractive bid in a competitive housing market. So we have helped many of our clients over the years to set up what's called a pledged asset line, which is a credit line that uses their investable assets as collateral. So a pledged asset line has a much more attractive interest rate than a margin loan. And it's much easier to apply for than, for example, the process of obtaining a mortgage or a home equity line where you have to get appraisals and go through an extensive underwriting process. If you have a pledged asset line, you can help your child to make an all-cash offer. So in this example, you would borrow from your credit line without selling any of your investments, lend the funds to your child in lieu of a mortgage for purposes of them to go forward with an all-cash offer. And then if the offer is accepted and the purchase closes, your child can then apply for a mortgage after the fact and repay the loan to you. Of course, you would only want to consider some kind of creative financing strategy such as this if you are confident that your child will qualify for a mortgage and if you are willing to carry the loan for a longer period of time, if you need to, with your child making payments to you and then you making payments on the pledged asset line. We always encourage clients to save for their child's college through 529 accounts, and we encourage grandparents to do that as well. Sometimes clients are a little reluctant to fund those accounts too aggressively because they don't really know what their college costs might work out to be. For example, they don't know, will their child go to a public school, go to a private school? Will they be in college for 4 years or for 5? Will they go to graduate school? Will they qualify for any scholarships or merit awards? Or will they go to the military academy where there won't be tuition? Each 529 account has an owner who's typically the parent of the child who's going to go to college and a beneficiary who's the child. 529 accounts are unique in that you make a gift, but they are not irrevocable gifts. The owner, who's often the person making the gift, but not always, still retains control. So there are some who have saved aggressively into these accounts and then discover when the time comes that they have more saved than they need. So, which is a great problem to have, right? So if you find yourself in this fortunate situation, there are various things you can do beyond simply withdrawing and paying the 10% penalty for withdrawals on non-qualified expenses. That option's always there, but not a very attractive one. If the overage is because your child received a scholarship or is going to be attending a U.S. military academy, you may withdraw the funds from the account without penalty, although you do have to still pay taxes on the earnings. So you can withdraw up to the amount of the scholarship without penalty. The owner may also change the beneficiary to someone else who's within the same family tree. So for example, you can change it to another sibling, you could change it to a cousin, you could change it to a parent, you could change it to yourself. You have to be careful though, if you're going to change it to someone who's lower on the family tree. If you look at your generations in your family tree, as a rule, it's best to keep the transfers to someone who's lateral or higher up. If you go and transfer to funds that are lower, to a person who's lower on the family tree, then you may run afoul of the what are called the GSTT, the Generation Skipping Transfer Tax rules. You may also use the balance to pay off student debt of up to $10,000 for another family member. So if you have an older child that is out of school and has some debt to be repaid, you could transfer to them and use it to pay off their debt. You can even change the beneficiary to yourself if you're interested in going back to school for some form of higher education. So these are all ways to change the beneficiary of the 529 account. Changes of the owner are allowed in some instances. Some states allow changes anytime, but other states only allow it in the event of the death or incapacity of the owner. So you have to be careful about trying to change the owner of the 529. This brings us to the end of our webinar today. I want to thank you for joining us. We have covered a lot of information. If there are other topics that you hope that we will cover in a webinar in the future, please send us your suggestions. You see our email addresses there. If we can be of any assistance to you in your financial journey, please do not hesitate to contact either of us. And I hope you can join us at the same time tomorrow when Lisette talks about aging parents. Hope to see you there. Thank you.
Wait, Margaret, I was going to ask you a couple more questions if you have time for that.
Yes, of course.
You were mostly talking about unused 529 plan balances, but in terms of what people can spend the 529 plan on, things like educational travel or housing, would you encourage that for before they graduate to use as much of the 529 as possible?
Yes, there are, you have to be careful about travel, but there are things like computers, books. I mean, there are other things that you can use the funds for. There's a long list of what is considered an eligible expense. There are rules about how much you can, for example, if your child is renting an apartment and going to school, there are rules about how much you can spend. You can't have them rent the most lavish, beautiful apartment in New York City and have the whole cost covered by the 529. But yes, there are some other areas that you can use. So I would certainly be very, keep all your receipts and have all of your records, but you want to use the 529 funds to help offset all of those expenses. You also have to be careful, I should also add, that you withdraw from the 529 in the same tax year that you incur the expenses. And this can get a little tricky, especially if you are paying as you go and then planning to get reimbursed out of your 529 account. If you're paying some of the tuition in September and some of it in the next semester, you want to be sure that your withdrawals line up with when the bills and when the payments were made.
Yeah, that's a very good point. In terms of some of the resources you gave here, we'll offer to provide those in terms of where you could get the documents. And you mentioned a couple of budgeting tools for your kids. We can provide that to whoever is interested.
Yes. I don't think I said this when I talked earlier, but there's a website that I know is very popular for those estate planning documents. It's called Mama Bear Legal. That is a very inexpensive way to get some very simple, I would not use it for your own more complex estate planning needs, but for your teenager who just needs something very basic, that's one way to get it. Or as I mentioned earlier, you could just use your own as a template or contact your own estate planning attorney. But of course, when their situation becomes more complex and they need wills and trusts, et cetera, they should go and have it done in a tailored fashion by an attorney. I mentioned Simplify was the budgeting app that I think a lot of people have found to be helpful. I will also mention the website Investopedia. I find that it has really good information. So if your child gets interested in these topics, or if there's something that I've mentioned here that you're not feeling familiar enough to teach to your child, they have very good information, and it seems carefully reviewed and vetted. It has very high accuracy, and so that's a good place to learn more about some of the technicalities of some of these rules if you're interested, or if your child gets interested in these topics.
Excellent. Thank you so much. That was so informative. And yeah, I hope people can join us tomorrow for the rest of the Gen X Sandwich Solution series. We'll talk about conversations with your aging parents and kind of, how to be as helpful as possible on the other side of this equation. So we will see you then. Thank you.
Excellent. Thank you so much. Bye-bye.